We are currently witnessing the end of an era that lasted 5 centuries. For half a millennium, the word Switzerland was not just a name on a map, it was a global brand for invincibility. It was the world's safe room. Whether you were a European monarch fleeing revolution, a 20th century industrialist surviving a world war, or a modern-day tech mogul, the Swiss vault was the ultimate destination. But in early 2024, a tectonic shift occurred. In the glass-walled boardrooms of Hong Kong and the high-tech family offices of Singapore, the conversation changed. Wealthy families are no longer asking if they should move their money out of the Alps. They are asking how fast they can do it. According to the Boston Consulting Group's 2024 Global Wealth Report, 2026 will be the year history flips. Hong Kong is on track to surpass Switzerland as the world's premier offshore wealth hub. By 2028, the gap will be unmistakable, with over $3.2 trillion in assets under management in Hong Kong alone. This isn't just a market correction, this is the collapse of a fortress. Today, we analyze the 3 pillars that fell, the scandals that rotted the foundation, and why the Wild East is winning the war for the world's gold. Chapter 1. The Anatomy of the Holy Trinity. To understand why Switzerland is failing, we must understand the 3 pillars that made it the master of the financial universe for 500 years: absolute secrecy, permanent neutrality, and tax stability. Pillar 1. The religion of secrecy. Swiss banking secrecy wasn't just a policy, it was a cultural religion codified in the Banking Act of 1934. In Switzerland, revealing a client's name wasn't just a breach of contract, and it was a criminal offense punishable by prison. This created an impenetrable wall between wealth and the governments that wanted to tax or seize it. During the Cold War, Swiss banks accepted deposits from both sides of the Iron Curtain. They stayed silent through military coups, oil booms, and the rise of manufacturing dynasties. By the 1990s, Switzerland managed 1/3 of the entire world's offshore wealth. Pillar 2. Strategic neutrality. Switzerland hasn't fought a foreign war since 1515. This neutrality was a strategic masterpiece. It meant that in the middle of World War II, when the rest of Europe was in ashes, enemies could meet in a Zurich hotel lobby without fear. Neutrality allowed Switzerland to be the world's back channel. If 2 nations didn't talk to each other, they talked through a Swiss intermediary. For the global elite, Switzerland offered something no other nation could: plausible deniability. Pillar 3. The tax haven. The Swiss cantonal system created internal competition, driving tax rates to levels that made other European nations furious. It was a race to the bottom that benefited the wealthy. Combined with secrecy and neutrality, these 3 pillars formed an unbeatable value proposition. By 2010, the country managed nearly $2.7 trillion in offshore assets. Chapter 2. The First Crack, the Birkenfeld Bomb. The beginning of the end can be traced back to 2008. It didn't start with a war, but with a USB drive. Bradley Birkenfeld, a wealth manager at UBS, that became the most hated man in Swiss history. Birkenfeld wasn't a hero, he was a banker who got caught in a dispute over a bonus. In retaliation, he walked into the U.S. Department of Justice and revealed everything. He described a world of espionage, Swiss bankers smuggling diamonds in toothpaste tubes, traveling to the U.S. on tourist visas to meet clients at yacht shows, and using encrypted communications to bypass the IRS. The U.S. government launched a legal siege. In 2009, UBS surrendered, paying $780 million and, more importantly, handing over 4,700 names. The sacred covenant was broken. By 2014, under pressure from the OECD, Switzerland agreed to the automatic exchange of information. The vault door, once made of thick steel, had been replaced with transparent glass. Chapter 3. The Moral Decay, the Credit Suisse Horror Story. If the loss of secrecy was a wound, the collapse of Credit Suisse was a terminal infection. Credit Suisse was the crown jewel of Swiss banking, founded in 1856. But in the last decade, it became a case study in institutional failure, the tuna bond scandal. In 2016, Credit Suisse helped arrange loans for Mozambique, supposedly for a fishing fleet. In reality, the money vanished into corruption, leaving one of the world's poorest nations in crippling debt. The bank paid nearly $500 million in settlements, but the reputational damage was far worse. Archegos and Greensill. In 2021, two massive disasters struck within weeks. First, the collapse of Greensill Capital, a supply chain finance firm, cost clients over $10 billion. Then, the Archegos Capital Management disaster saw the bank lose $5.5 billion virtually overnight due to reckless leverage and zero risk management. These weren't accidents. They were proof that the Swiss precision was a myth. The Swiss secrets leak. In 2022, a massive data leak revealed that Credit Suisse had knowingly managed accounts for arms dealers, human rights abusers, and drug traffickers. The bank wasn't just losing money, it was losing its moral claim to neutrality. It was no longer a safe harbor, it was a laundromat. Chapter 4. The 2023 Shotgun Wedding. When Silicon Valley Bank failed in early 2023, the world looked for the weakest link in the global chain. They found Credit Suisse. In a single quarter, clients withdrew $120 billion. It wasn't a bank run, it was a stampede of the world's most sophisticated investors. And the Swiss government faced an impossible choice: let the bank die and destroy the global economy or force a merger. They chose the latter, forcing UBS to buy its rival for a fraction of its value. This shotgun wedding created a banking behemoth with assets exceeding $1.6 trillion, more than double Switzerland's entire GDP. Economists now call this systemic risk concentration. If the new UBS ever stumbles, the Swiss government lacks the fiscal capacity to save it. The nation that once rescued the world's wealth is now a prisoner of a single institution that is too big to save. Chapter 5. The Death of Neutrality. The second pillar fell on February 28, 2022. When Russia invaded Ukraine, Switzerland faced a choice: maintain 500 years of tradition or join the Western sanctions. Under immense pressure from the US and EU, Switzerland froze billions in Russian assets. To the Western world, this was a moral victory, but to the financial world, it was suicide. Neutrality was Switzerland's product. Wealthy individuals from China, the Middle East, and Latin America didn't bank in Zurich because they loved the scenery. They banked there because Switzerland didn't take sides. The announcement sent shockwaves through private banking. Wealth managers in Dubai reported that the mood among their clients was apocalyptic. If Switzerland could freeze Russian assets today, whose assets would they freeze tomorrow? The promise of political immunity was dead. In the year following the sanctions, net capital inflows from non-European clients dropped by 18%. Chapter 6. The Populist Tax Threat. As if external pressures weren't enough, a threat emerged from within: the Juso Initiative. In 2024, a Swiss political movement proposed a 50% inheritance tax on fortunes exceeding 50 million francs. Billionaires are allergic to uncertainty. The mere discussion of this tax caused an immediate uptick in residency applications for Monaco, Dubai, and Singapore. The Swiss tax stability pillar is cracking. Wealth managers note that family offices are restructuring their assets to be domiciled outside of Switzerland. Like France in 2012, Switzerland is learning that when you tax the rich too heavily, they don't pay. They leave. Chapter 7. The Rise of the Asian Giants. While Switzerland was imploding, Asia was executing a decades-long strategy to capture the world's gold. Hong Kong and Singapore didn't win by accident. They won by design. At Singapore, the new family office capital. In 2018, Singapore had 50 single-family offices. By 2024, that number exploded to over 1,600. Singapore offers what Switzerland can no longer provide: strategic ambiguity. Singapore maintains deep ties with both the US and China. It is the ultimate neutral hedger of the 21st century. Hong Kong, the gateway to the East. Despite political headlines, Hong Kong remains the primary conduit for the world's fastest-growing wealth pool, mainland China. It now hosts over 2,700 family offices. For Asian wealth, the decision is simple. Why fly 12 hours to Zurich when you have world-class infrastructure in your backyard? The technology gap. This is perhaps the most underrated factor. Swiss banks are conservative and slow. They still rely on personal relationships and physical meetings. In contrast, Singaporean and Hong Kong banks have embraced the digital revolution. From real-time AI-driven portfolio management to seamless blockchain and cryptocurrency integration, they are building for the future of wealth. Younger billionaires, the tech founders and crypto moguls, expect their banks to feel like Apple or Google. Swiss banks still feel like a library. Image comparing wealth management assets in Switzerland versus Hong Kong and Singapore, 2024 to 2028. Chapter 8. The Great Wealth Transfer. The shift we are seeing is part of a larger structural realignment of global power. In the 20th century, wealth sought invisibility. In the 21st century, wealth seeks optimization. In the past, you hid your money in a Swiss vault to keep it away from the world. Today, you move your money to Asia to put it to work. Wealth is no longer passive. It is active. The rise of China, the growth of India, and the industrialization of Southeast Asia mean that the center of gravity has moved. One Swiss wealth manager put it bluntly, "My grandfather said Switzerland was the world's mattress. Everyone wanted to hide their money under it, but today money doesn't hide. It moves to wherever offers the best combination of growth, stability, and alignment with power." Chapter 9. Can Switzerland recover? Is this the end of the road? Not necessarily. Some argue that Switzerland will reinvent itself as a boutique hub for ultra-high net worth Europeans. It still has the crypto valley in Zug and world-class legal frameworks. But to survive, Switzerland must abandon its 19th century arrogance. It must embrace digital asset management, radical transparency, and a new value proposition. The safe room is gone. Now it must become a service room. However, the most likely scenario is a slow fade into irrelevance. As Asian financial centers mature, Switzerland will continue to lose market share year after year. Not a sudden collapse, but a gradual erosion until it is merely a regional player in a multipolar world. Conclusion. The lesson of the fortress. The fall of Swiss banking dominance teaches us a vital lesson. Empires built on trust collapse faster than empires built on force. Switzerland didn't lose a war. It didn't suffer a natural disaster. It simply lost the one thing it couldn't print: credibility. It lost it through external pressure, internal greed, and a refusal to adapt to a changing geopolitical landscape. The world didn't lay siege to the Swiss fortress. The world simply built new fortresses elsewhere, and in the end, that is far more devastating. The Swiss vault has cracked. The question for you is, in a world where capital moves at the speed of light, where will you put yours?